we go into mutual funds, I actually want to show you guys an example of ESPP and why I tell you guys to invest in ESPP before you do your savings, right? I want to make some of y'all some believers in here, okay? I give you guys 2 examples. So an ESPP typically has an option, what is known as an option period. A lot of companies will pick 3 months, some companies will pick 6 months. It depends on your company. That's why you need to know the rules of your company's ESPP. In this one, I took an example because I'm picking on him. So he works for a company called VMware. So I don't know if they do a 3 months or 6 months. 6 months, okay. And do they give you the price at the end of the 6?
Price at the lowest point between the 6 months.
I know. You're killing me. Okay, I'll hold that. All right, so I just assumed that they gave you the lowest price at the end of the 6 months, right? So this was the closing price for his company on June the 28th, because it closed on June 30th, I believe was a Sunday. All right, so it was $167.21. What the company will do is they give you a 15% discount, right, on this price. So the price you pay for each stock is $142.12. If you max out, because typically what they do is they tell you that you can put in 10% of your income up to $5,000, right? So let's say that you're able to max out your account, so $5,000. $5,000 divided by $142.12 is 35 shares, okay? So you now have 35 shares of VMware. If you sell this immediately at this price, instead of having $5,000, you have $5,845, okay? You can't get $845 in no savings account. That's why I tell you to max this one out if you can.
But how did you get to 847?
You take 35 times 167.21.
Is this a yearly thing or just a quarter?
It depends on the company. Most of they do it every single year based for every quarter. Okay, I'm going to show you an example of our company, okay? And they do the same thing you guys do, only I didn't know that. I just assumed that they give you the closing price. So our company has a look-back period. We have a 6-month option period, so between January 1st and June the 31st, right? And they take the lowest price and they give you 15% off the lowest price. So at the beginning of the year, our stock was $30.95. June 28th, our stock was $63.26. Because what the company does is they take the lowest one and they give you a 15% discount. If you take 15% of $30.95, it is $26.30. So I get to buy the company stock at $26.30. That gives me 190 shares. If I had 190 shares and I sell it at today's price, how much do I have?
Oh, wow.
Yes, that's why you always invest. You max this out if you can.
So can you put a percentage of your income?
You put a percentage. So the first thing to remember is this is after-tax dollars, right? And you put a percentage you put 10% up to $5,000.
$5,000.
Yes.
And you can only buy up to $5,000 in a year.
And no, 10,000 in a year. It depends. It depends on what your option period is. Okay?
I need to investigate this.
Please, everybody who is in a public company, go investigate this. This is free money.
Are option periods always twice a year?
It depends on your company's rule. So when I worked at TI, it actually was 4 times because they did it quarterly. So they did it every 3 months.
But you still could do 10,000 or was it like 2,500?
It was 2,500 for each one. It was a total of 10,000 for the year. Okay? So even if let's say the stock went down, right? Let's say it's not at 63.26. Let's say the stock went down. I cannot lose money in this scenario. You cannot. You always gain. Always. As long as you sell immediately.
So what you do is you put your money in and then you sell it right away.
Yes. And you get money back.
So you put your money in at the beginning of your option period. Once it's over and you have this shares in hand.
It's not at the beginning. They take it out every paycheck.
Right.
Yes.
So like after a 6-month period,
Yes.
you sell it.
Yeah, after a 6 months period, at the end, they buy the shares for you. And then once you have the money in the account, you can sell it immediately.
So there's no restriction on how soon? There's no
what you don't, the only thing to remember, I'm glad you brought up that point because I was going to tell you guys and then I forget. Remember, Uncle Sam's always going to want his cut. All right, $5,000, I made $845. I have to pay capital gains tax on $845. In this scenario, I have to pay capital gains tax on $7,019. But I'll happily pay taxes on this and just have the money.
Yeah.
All right. So are you guys all convinced now? ESPP? Good.
I heard something the other day that people don't invest because they have to pay taxes.
Oh, please. Are you paying taxes on $0?
Oh, what's that movie Mojo that goes?
Guys, what she said, one of the things I like this morning I was asking myself, why am I coming to this class, right? One of the things I like coming to this class is that we are in the right environment for us to open our minds to investment and wealth, right? That statement she just made right now is one of the things that people do. We can all laugh about it, but subconsciously, she mentioned two things, fear and greed. Subconsciously, people are trapped in this old stupid mindset of taxes. Question, if I have to pay taxes on 30% and I'm keeping 70%, I'm good because
You're still keeping
if I
money.
have zero, you get what I mean? Because I've seen people do this stupid thing. Oh, I want to make more money because they're going to tax me. So you want to be poor? It doesn't make sense, but people do it every day. It doesn't make sense. So I'm saying this, I'm adding to what she just said because we're all going to get there. You're going to get to that place. There was a time I paid my taxes, guys, I was crying. My kid was there, and she said, Daddy, sorry. And I told the lady, I said, so they are punishing me for making more money. The lady said, welcome to America. But as I was driving home, I felt better because
You're making more
reality,
money.
I wasn't making that kind of money last year. Now I'm making it. I paid more, but guess what? I also made more.
Exactly.
So what I'm getting at is that this thing sounds simple and all, but you're going to meet friends.
I'll just say this. Everybody from church who didn't show up, they missed out.
So the other thing I was going to say, remember I also said make sure you guys get you a good accountant, okay? The accountant is there to help you mitigate how much taxes you need to pay, all right? All right, let's jump into mutual funds. All right, who knows what a mutual fund is in here? You do now. All right, mutual funds are financial investments or financial instruments where basically you have a bunch of investors who pool their money together. And now you have a mutual fund manager, or the mutual fund now invests in different stocks. So remember I told you that a stock price only tells you if you can afford the stock or not. We looked at Berk A, right? Stock price is over $300,000. Can I afford it? Absolutely not. But what if I want to invest in Berk A? I can buy a mutual fund that invests in Berk A. So you'll see mutual funds that have a portfolio and they have lots of different stocks, they might have bonds, they might have different things which they invest in according to the prospectus of that mutual fund. So the way that mutual funds work, so you have investors, right? So let's say all of us come together. Let's say each of us gives $1,000. How many of us is in here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, right? So 18. So now we have $18,000, right? Everybody gives $1,000. Based on that, now somebody who's a fund manager, let's say I'm the fund manager, I take that and I choose the funds. But before that, I have a prospectus that tells you how this mutual fund invests its money. So I might invest in large cap companies, okay? So these are companies that have over $200 billion in market cap valuation, okay? Or maybe I invest primarily in bonds. So I have a portfolio that is in bonds. So I have a prospectus to let you guys all know how I invest. Then I buy the securities and asset, I generate gains, I pay you the gains back in returns, maybe dividends. It's a combination of dividends and also the price of the mutual fund increases, and then it goes basically back together or in a loop. Does that make sense, how mutual funds work? All right. Some of the benefits of mutual funds is that it really is a diversification value or method or vehicle. If you think about buying a stock, I am exposed to the whim of that individual stock. We talked a little bit at the beginning about my company stock, Pros, that has gone down by almost $10 in 2 weeks. I'm like, oh my God, right? I have a ton of money and I'm just watching that money. I'm like, well, I'm on along for the ride now. So it's going down. However, if I was in a mutual fund, I am protected. You might have different assets in that mutual fund going up or going down, but you won't see wide swings in a mutual fund because it's a diversification vehicle. Does that make sense, everybody? All right, you can purchase assets that would otherwise be too expensive. This goes back to the Burke A. Mutual fund managers, they are playing with millions and billions of dollars, right? So they can buy whatever they want to buy. I don't think there's an asset that's going to be too expensive for them. Whereas for me, I can't afford Burke A because I can't afford $300,000. You can also rely on the investments and expertise of financial managers. And I put an asterisk here because I'll talk a little bit about that later. But you have somebody who knows what they're doing. Instead of you having to individually pick different stock, you have to do your research, you have to go evaluate tools, you need to be sitting in on earnings call. You can just basically give your money to somebody who's a mutual fund manager and they manage the money for you, okay? And then the last one is dividend reinvestment. So we talked a little bit about compounding interest. Now imagine if you're getting dividends and you take that money and you put it back into the mutual fund. So you're now growing, significantly growing your investment in that mutual fund. Okay? Yes?
So because it's a pool of money, are the returns then lower?
Yes,
okay.
than stocks.
Okay.
The average return on a mutual, let me say it depends. The average return on a mutual fund is going to be dependent on, I'm actually going to show you guys how to read a mutual fund chart. But remember, the greater the risk, the greater the reward, the lower the risk, the less reward. When you have something that's so diversified, what you're doing is you're managing risk. So if I was invested in a mutual fund that has my company stock Pros, as the company's swinging up and down, right, I don't see my portfolio swinging up and down because exactly. So it might swing up, but it might swing down, but then there's something else in the mutual fund that's carried it up a little bit. So you won't see the wide up or down swings, but it helps you to comfortably grow your portfolio at a lower risk profile.
Are these fund managers making money based on gains?
Yes. Well, not only gains, they charge you to be able to participate in a mutual fund. I'll show you. Yeah. She said, you didn't say that. Everybody's going to charge you money for something. Come on, man. Only Robin Hood.
They have the free side and they have the side where
You're paying.
I'm looking at it, they have the free, but they also have, if you really want some help.
Yeah. Okay, so here are some of the top things to remember when you think about mutual fund. When you're buying a mutual fund, you're buying the performance of its portfolio. Remember, you're not just buying it in individual stock, you're buying a portfolio of stocks, okay? So you're buying the performance of the entire portfolio. This is key, and I'm going to show you this when we start reading mutual funds. Every mutual fund has an underlying index that it is compared to. It's called a benchmark index. That's how you can tell how well that mutual fund manager is doing, okay? Are they beating their index? Are they low? Are they below their index? Are they on par with their index? And we'll talk a little bit about what an index is in a few slides. The other thing to remember is that there is some expense or cost to participate in a mutual fund. And I'll show you guys what the expenses are. The expense typically is a percentage of how much you have in that fund. So if I put $10,000 in the mutual fund and I have a 0.5, so they'll charge me 0.5% of that $10,000 to participate in the mutual fund. A lot of some mutual funds might also have what they call a load fee, meaning that as you are giving them your money, so let's say they have a load fee of $500, or let's say a load fee of 5%. As I'm giving them the $10,000, if their load fee is 5%, then they've already taken $500, so I'm actually only investing $9,500. Okay? So you need to understand what the costs are to participate in mutual funds, because you're trying to minimize your costs, minimize your tax, so you can make your tax consequences so you can make more money. All right? Some mutual funds require you to have a minimum investment amount. So some might say you have to be able to participate in this fund, you need to invest at least $2,500. Some might not have a minimum, so it depends, and I'll show you guys where you can see that. If you want to buy a mutual fund, the order is executed at the fund price at the end of the day. Remember, when we're looking at stocks, you can buy throughout the day, and the stock price might go up or down throughout the day. But when you're buying a mutual fund, it's executed at the end of the day, okay? And that's when if you want to sell, buy, whatever, all orders are executed at the end of the day. Mutual fund managers, I'm going to give you guys two terms, okay? And I'm going to confuse you a little bit. We talked about active versus passive investing, right? You can also have active or passive investing when you're dealing with a mutual fund. If there is a physical fund manager, it's considered an active investment. If the mutual fund is following an index, it is a passive investment mutual fund. Okay? If there's a human being managing the mutual fund, it's active. If it's just tracking an index, it's passive. Okay? Yes?
Question. Where does AI come in all of this?
AI is like in the middle, right? You have physical people, you can have AI that's also modeling algorithms, and then you can also have something that is just following an index, regardless of what the market is doing.
Do you see a day coming where it's
Yes,
just
I do. They're already what they call robo-advisors. And the robo-advisors they charge you less than, if you go with a fund that has a robo-advisor, they actually don't charge you as much as a human. And some of them actually, the robo-advisors they're pretty good. Yeah.
Are you planning to cover the process of creating a mutual fund?
Creating?
Yeah, so what are the steps if you wanted, let's say if you wanted to pull together?
I don't know how to do that. he said, let's pool our money and let's create a mutual fund. No. You need, I don't know how to do that. You probably need SEC. We don't create mutual funds. We participate in mutual funds. Huh? He's thinking big picture. He was like, let's get our money together. I honestly have no idea what it would be required to create a mutual fund.
So if you ever figure it out,
Let us know.
write his phone number and you call us.
Yeah. All right, let's talk about an index. All right, because the term can be a little bit confusing. An index basically is just a set of rules of how a portfolio should be managed or what is inside a portfolio. The rules are put together by a governing body. So you hear things like the S&P 500. The S&P 500 is an index. What it measures is the top 500 companies in the United States by market cap. So you'll see people like Apple, Microsoft, Amazon, Exxon, etc. These are the top 500 largest company, and they make up the S&P 500. That's what the S&P 500 is. You also hear the S&P 500 being called the market, okay? And that is the best indicator of the market. The Dow Jones is actually just made up of 30 companies, all right? And the Dow Jones is not even market cap weighted, Meaning that if you have somebody like Caterpillar, I don't know who's on the Dow Jones, so I'm making this up right now. Let's say you have somebody like Caterpillar, and let's say they have a market cap of $200 billion, and you have somebody like Amazon, and they have a market cap of $1 trillion, right? When their stock price moves, you would assume that if Amazon moves more, the entire index should move more because they're weighted higher. The Dow Jones does not take that into account, but the S&P 500 does. So that's why they always tell you when you benchmark and when you think about the market, think about the S&P 500. The NASDAQ, this is confusing because remember, there's a stock exchange called the NASDAQ. Remember I asked you guys, it was like, what is it traded on, the NASDAQ or the NYSE? So the New York Stock Exchange and the NASDAQ. The NASDAQ is also an index. And that index basically just, I think I skipped it. The NASDAQ just basically tracks the majority of companies that are on the NASDAQ stock exchange, okay? And the other thing, you'll hear the NASDAQ being referred to as the tech-heavy NASDAQ. And that's because the NASDAQ is primarily made up of IT companies or what people will consider technology-based companies. So that's why they call it the tech-heavy NASDAQ. It's very, very tech-heavy. Okay? Everybody following me? Everybody understands what an index is? Fantastic. Okay, passive versus active investing, right? Remember I said when you have, the other thing I was going to say, with these index, these are just the top three big indexes that you guys know about. There are lots of indexes. There are indexes that follow bonds. There are indexes that, might follow growth companies. There is the Russell 2000. There are lots of different indexes. These are not the only three indexes that exist, okay? Now let's go to passive versus active investing. Remember, what did I say? Active investing is when you have what? A human being managing that mutual fund. Passive investing is when it's following an index, right? So if you look at what are some of the benefits and disadvantages, let's look at passive investing. There's little turnover because the index, unless that index changes, then the asset allocation is going to stay the same. Does that make sense? So that's why they say that there's little turnover. It's lower cost, okay? So I'll show you guys where to participate in a mutual fund that follows an index, it's actually significantly lower cost than if you were to participate in a fund where somebody manages. There's transparency, and then there's also tax efficient because they're not buying and selling all the time. Every time the fund managers make a sale on a mutual fund or on a stock, you pay taxes. You guys don't feel it because it's in a retirement account. Remember, those are tax sheltered accounts. So you're not paying taxes whenever the transaction hits. But if I was to invest in a mutual fund outside of a retirement account, I'll have a lot of tax, line items. All right. The disadvantage, it's limited options and there's little turnover. So take, for example, right now that the market has been doing seesawing, right? If you had an active fund manager, you could say, okay, I want to protect my investment. I don't want to invest in as much stock. Let me invest in bonds. They can make the decision. But if you're following an index, you're just stuck. Does that make sense? All right. Fund manager. So this is active investment. So it's actively managed. They're flexible options. They can employ some risk management tactics, so try and protect your money during a recession versus if you're in a passive investment vehicle, your money is exposed because it's just tracking an index. The disadvantages is that it's higher cost than doing a passive investment. Okay. And then there is portfolio turnover. Remember, every time when I say portfolio turnover, it's how often are they buying and selling new assets. So how often might they be buying new bonds, or how often are they selling stocks? And then it's also tax inefficient. So based on these two, you guys would assume that which one does better? Really?
Well, for us.
So which one? Who thinks active does better? Who thinks passive does better?
I was just looking at. That's like an option for us.
No, like just in general. Like in general, who has better returns overall? Active. Right. That's what you would think, right? Okay, let's look at it. Yes. The Lone Ranger. A lot of this actually, so the founder of the index passive investment vehicles was John Boyle, who passed away a couple of months ago. Warren Buffett, the majority of fund managers now are putting together a portfolio that actually just track indexes. If you look at it, this is the percentage of fund managers who underperform their benchmark. Remember I said every single fund has a benchmark. If you see this, for those that invest in large cap, 85% underperformed their benchmark over a 10-year period. Small cap. Yes, consistently underperform. 85% for small cap and 88% for mid cap. Meaning that, so if their benchmark, if you have a return of 10%, right, as the benchmark, they might get like 8%. So it doesn't mean that they're not making money. It just means they're as much.
They could have made more.
Yes, if you look at it from their benchmark.
But how does that compare to what they would have made if they would have put that money in the other one?
In the passive? Then that's so the delta. So again, if you had your passive index or your index has, let's say, made 10%, they only made 8%. The delta is 2%. So it's just how much could you have made if you had gone with an index instead of with the actively managed account? So this is something that you'll see is hotly debated. In fact, this week, the guy who is the whistleblower for what is it called? I can't remember. The whole mortgage-backed crisis. He came out and he was now saying that there's a bubble developing within the passive investment, blah, 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 blah. I mean, there's debate. It's hotly debated whether you should do passive or if you should do active. But Warren Buffett said that when he passes, he has given his wife instructions, save your money or invest your money and just invest in index funds. You're talking about the greatest investor that ever lived. He didn't recommend any manager. He told him just go with an index fund. Yeah. All right. So here I just put in a financial tip. Invest. If you try, what I try to do is I try to follow passive investments. Why? They're cheaper and they perform better, significantly cheaper. So, all right. Let's go to reading a mutual fund. Let me show you guys how to read a mutual fund. I put the fund names here because FADMX. Y'all remind me of that ticker. Where is my FADAX? MX? Yes. Thank you. I'm probably logged out of here too. It's okay. We'll try. FADMX. Aha, here we go. So an index fund tells you a lot of different things, right? So this is and you have lots of different tickers. You can do lots of research on mutual funds, right? So this one is the name of the fund is a Fidelity Strategic Income Fund, all right? There are a couple of things you need to pay attention to. When you open a fund, I don't really look at the overall ratings, although you might, it just depends. You see the returns, it's pretty average. The expenses are low, and here the risk. I look at the risk. I'd be like, but it honestly, this section doesn't really play a part of what I'm thinking. This section now is what I focus on. Okay, so the year to date, they've made 9.35%. Over 1 year is 6.42, 3 years, 5 years, 10 years. So over 10 years, the average return is 5.69%, okay?
How old is this fund?
This fund the inception was 1994, but it doesn't matter. I don't care. I won't tell you to care about what time, when a fund was opened or not. So the next thing I'll look at is the expense ratio. That's how much. Remember, I told you that the bonds require you to pay something, or sorry, the funds require you to pay something to participate in the fund. The expense ratio for this one is 6.9. For me, I automatically know that there's a fund manager, because typically when you see passive investment vehicles, they're around 1% or less. Oh, sorry, not 1%, 0.01% or less. You'll see it is. Yeah, for passive. All right, so expense ratio is 0.69. It's pretty good. It's not high. To me, high is anything that's over 1%. So this one's not bad. Minimum, remember I said it requires minimum to invest. So this one, there's no minimum. So $0, right? The other thing I'll look at, so what category? Oh, look at this. It's a bond. So now that makes sense as to why the 10-year is only 5.69. Okay, remember I told you bonds are not going to go as high or as low, but they protect your portfolio. All right. So now that I know that it's a bond, I know that there's no minimum and the expense ratio is 0.69. Next thing I'm going to look at is, so for the 10 years is 5.69 for a bond. It's doing well. I'm going to tell you guys to go down here and look at the fund managers. I actually didn't notice until I took the investment class. The reason I tell you to look at the fund managers is because you want to know who is responsible for the performance. All right, so this one, he's been here since 2012. So that 5.69, is he really responsible for it? No, because he hasn't been there for 10 years. Okay, so you see how you got to look at that? So he's been here for 3 years. So you can say, okay, the year to date, 1 year, 3 year, 5 year, he's responsible for. So that's why you look at the tenure of the fund managers. All right. So this guy has been here since 1999. This one since 2009. So it's like, okay, so these guys have been here for 10 years. Some of these other guys are new. So you've got to look at that as you think about, is this a good fund to invest in? All right. The next thing you look at is the assets. So remember I told you there's a prospectus, or there's an overview. This is the prospectus. So objective to invest seeks a high level of current income. The fund may also seek capital appreciation. That's basically how the fund is managed. That's their vision, or I don't know how you say it, marching orders. What are they invested in? So you see that their top 10 investment, they're invested in Japanese government bonds, USTN, I think that's US Treasury notes, German bonds, Ally, so this is a corporate bond, and US Treasury bills. Okay? So that's what I believe, USTB, because I'm not familiar with that term, but I believe, don't hold me to it. So this is basically how you read a fund. Now, remember I told you that there's always an underlying index, right? This one, the underlying index here is, let's see, let's go to performance and risk. The underlying index for this Fidelity Strategic Income, it gives you two. So here there is the FID Strategic Income Comp Index, and then also the aggregate, the BBG US Universal. These are two indexes. So look at how they perform compared to their index. Do they match, or are they lower? Yeah, they're lower. So why invest in this when I can just go buy something that follows that index?
Follow the index and it's cheaper.
And it's cheaper, exactly. So do you see how now you start to look at the performance of a fund, of a mutual fund? All right, let's go to the next one. What was the next one? FXAIX.
Oh, that's S&P.
FX. You know that from the top of your head?
Yeah.
Yeah. I don't know why you know that from the top of your head. Yeah. So you see here, right? So this one it tells you it's a Fidelity 500 index fund. This is an index fund that follows the S&P 500. Okay? It tells you what is the blend. It's a large blend. That makes sense because the S&P 500 follows the top 500 largest companies in the U.S.
Can we go back to something?
Okay.
while we're doing this, so like if I open up this stock app, right?
Mhm.
Right at the top, it has the S&P 500.
Yes.
So that's what it's following.
That's the index.
And that's just pretty much the whole market.
Yes.
In S&P 500.
Yes, the top 500 companies in the United States.
Okay.
Okay, so let's look at this. It's large blend, right? The next thing is that, can you see here? This is the cost, 0.015. So it's significantly lower, right? All right, good. Minimum to invest, 0. The key thing that you'll see, so you look at the top 10 holdings. This is by market cap. These are the largest companies in the United States by market cap: Microsoft, Apple, Amazon, Facebook, Berkshire, etc. Right? Makes sense? You look at the performance, 20.5, all the way out to 10 years, which is 13.4%. Okay? So, and then the last thing you see here is that there's no fund manager. Why?
Is it policy index?
Exactly. It's an index fund, so it doesn't need to have a fund manager. Now, one of the things I want to caution you guys, here, let me show you. So you see here the Fidelity 500 Index Fund right here. Where's my little clicker? Do I have a little? There it is. Yeah, it's right here. S&P 500 Fidelity. Can you see that it's closely matching? It's following the index. Okay. It's not going to match like to the 10th decimal point or whatever, but it's going to closely follow that, and it's significantly cheaper.
So do you know anything about the Admiral class?
Is that the dividend fund?
Yeah,
Mhm.
it's like some like how it's.
Mm-hmm. There are lots. So that goes into when you start to put together your fund strategy. So does that make sense on what to look at? Okay. When you're and you guys have to think about this, because when you're picking your funds, right, in your retirement portfolio, that's how you analyze how good a fund is.
See, now I need to go back and look at what
It's-
I have and make a determination.
Yes.
If what I have is right
You
or
should
not.
keep exactly. So remember, this is what I said. Is there a minimum amount to invest? What are the costs? What are the top holdings? What are the returns? How is the fund compared to its benchmark index? Who are the fund managers and how long have they been there? These are the key things you guys need to remember when you're analyzing a mutual fund. I'll send y'all the slides if y'all want them. Wait, did he just drop his phone? Okay, all right. Let's talk about ETFs. ETFs can be confusing. It's just a fancy way for saying a mutual fund that trades like a stock. That means that whenever you go on what do you call it, Yahoo Finance, you can actually find that mutual fund because it trades like a stock. And when you think about a mutual fund that trades like a stock, so think about what did I say about when the mutual funds, when do they execute the orders? End of day. That's the only time you can buy and sell. So if a mutual fund goes down in the middle of the day, you can't buy it. You got to wait till the price at the end of the day. An ETF allows you to buy throughout the day. So it trades like a stock. You'll see a stock price. You'll see everything. You basically can pull it up on Yahoo Finance. That's a big difference with what's called an ETF. And ETF stands for electronically traded fund. Okay, mutual fund trades like a stock. There are different types of mutual funds. The market ETFs, they track an index. Bond ETFs, sector, commodity, whatever, right? There are lots of different ETFs. I'm not going to go through all those because it just helps you to understand how you put together your portfolio, because remember, you want to diversify. So if you want to buy some commodity ETFs, right, you want to invest in commodities, you want to buy some sectors, you want to buy some bonds, you want to buy some markets. Okay? Yes?
So for the amount that they take out for like the 3% or 1% or whatever, does that come off of the like interest that you get?
No, it comes off of how much you put or what you put in. So if you have, let's say, 10%, and they take out 1% of that, so you're giving them $100, right? Did I say that? Did I do that right? Is my math right? 10% of 10,000? Did I say it? Huh?
You just said 10%. You just said 10%. You just said
Oh, sorry. I was thinking it in my head. I didn't say it out loud. So let's say you invest $10,000 and they charge you 1% to participate in the fund. Then they take out $100 to participate in the fund. The fund might grow, and maybe the dividends you get might be, I don't know, 10%, etc. But you would still have to pay. You pay that. The 1% is on your total balance that you have in that mutual fund. Does that make sense?
Yeah, but it's only a one-time thing then?
No.
Like monthly?
Isn't it quarter? Is it quarterly or is it semi-annually? I can't remember.
That's pretty much like how the dividends are that. So, yeah, it depends on the fund. It can be quarterly or
Semi-annually. Yeah. Okay, let's get to the fun part. Putting together investment strategies. I put in here, right, so the goal of investing is that you want your money to grow at the highest rate of return at the minimum risk that you can live with, okay? So when you're putting together an investment strategy, the first thing I want to make sure you guys understand is never, ever, ever invest money you need in the next 3 years, okay? There's a difference between putting your money in your retirement account, but if you are investing outside of your retirement account, don't put money you need in the next 3 years. Remember, we looked at different funds, and you'll see the year to date, or you'll see the 1 year, it goes up and down. 2-3 years, it might go up and down. You don't know when you're going to catch the market, okay? So you always are investing for the long term. So if you need that cash, whether you're planning on buying a house, whether you're planning on buying a car, although I don't recommend buying a car, whatever, if you need it for maybe you're doing a remodeling project, if you need a project, if you need that money in the next 3 years, don't invest it. Find something else that's safer to put that money in, okay? First thing you do when you're investing, you need to understand what your risk profile is, okay? You'll hear these terms being used: conservative, moderately, thank you. Moderately conservative, moderately aggressive, right? Your risk profile should also correlate with the time horizon of when you need the money. Meaning, my father is a very aggressive investor. Should he be? No, because he's going to retire soon. I don't understand why he's so aggressive. My father's like, if the money goes up, the money comes down. No, you need money, okay?
He's thinking, I need the money when I retire, so
Yes.
I need to be aggressive.
So you need to understand what are you personally comfortable with. If your account swings down by 30%, can you live with that? Okay? If she's like, no, I can't live with that. If you can't live with that, then don't invest in assets that can swing down by 30%. Because remember I said fear and greed. Greed, I was looking at Roku. I was telling you that Roku is one of the assets that I want to buy, right? Roku at the beginning of the year was like $40 or something. It's at $160. I'm like, man, I really want to buy it. But you know what? If it can swing all the way to 160 in a few months, guess what? It could come all the way back down. All right? Can I live with that risk? And maybe you want to invest in Roku, but you want to invest, let's say I invest $100, okay, or sorry, well, not $100, I can't buy a share. Let's say I invest $500, right? So I don't invest a huge chunk of money. I can still participate, but if my $500 comes all the way down to $250, I'm not gonna cry. I'll be like, oh, that sucks, but I'm not gonna cry. However, if I invest $10,000 and that share comes all the way down to $2,500, I will cry. All right? So that's what I'm talking about, is that you need to understand what your risk profile is. Second thing is you need to develop an asset allocation plan. All right? You need to diversify your portfolio. And when I talk about an asset allocation plan, the first thing that you need to look at is, what is your equity to bond split? Especially for those of you guys that are going to go and check on your retirement portfolio, right? The younger you are, the more you can expose yourself to equities. Why? Because it can swing up, down, you don't care. You're not getting your money till you're 59 and a half at best, okay? So you have years for your portfolio to do whatever it wants to do. And by the time you get to 59 and a half, you should be okay. However, if you're close to retirement age like my mom, I don't want to expose myself to the massive swings because I need that money when I retire. So you might have a conservative plan for her where she's invested in 60% bonds and 40% equities. Whereas Shidara might be invested in 90% equities or 90% stocks and 10% bonds. Does that you guys follow me there, right? Okay, so that's the first one. Determine your equity split. The second one is you need to, within that equity split, right? So remember, maybe I need to go to the board. Where's the marker? So, is there an eraser over there? Thank you, that works too. There, it's on the table. Where'd that blue marker go? That one actually wrote well. I did? Can somebody throw it over here? Yeah, but remember last time I tried to use them, they were, so you have so let's say 90% equities, and I'm using the term equities, right? And remember, equities is another term for what? Good. But you're not investing in individual stocks. Remember, when you are in your retirement portfolio, they give you like 20 or 30 different mutual funds that you can pick from, right? Okay, good. Say 10%. Now you don't want to write? So 10% bonds. Okay. When you're looking and you say, all right, 90% is in equities. Within this 90%, now you start to look at how much do I want to invest in large cap? How much do I want to invest in mid cap? We all understand these terms now, right? All right. How many do I want to invest in small cap? Do I want to invest in any international companies, right? And the good thing is that if you guys go home and actually look in your Fidelity accounts, it tells you what the different funds are, right? Remember, there's a prospectus that tells you how they invest that money. So let's say, remember, large cap companies tend to be more stable companies. Small cap companies tend to be less stable. You can go risky and you can say, okay, I want to invest 40%, let's say of the 90%, let's say 40% here. So now I only have 50% to play with. I say I want to invest 20% here, 60, right? And let's say here I do 20, and let's say here I do 10. That brings me to 90. Is that making sense? Maybe here, I don't know what you guys' investment, but let's say, remember there is investment grade. My handwriting is terrible. And then there are junk bonds. Remember, investment grade bonds are more stable, but are they going to give you a lot of returns? No, right? Junk bonds are a little less stable, but would they give you more returns? Yes. Okay. Maybe if they don't go under. So here I could say, okay, so let's say here I want investment grade. Let's say I do 10%. And here I do 0. Right? So this is how you now start to think it. And what I have out there, can you see the pie that was supposed to have numbers on it? I thought it had numbers on it. But that's basically how I put together this pie, right? So it shows how much I'm invested in bonds versus small cap versus mid cap versus international, etc. What you tend to see is that a lot of people will invest more in large cap companies because they're more stable. You'll invest more, you can invest in mid cap, and you can also invest in small cap companies, right? When you invest, not companies, funds, all right? Is that making sense? I want to make sure I'm using the right terms. So funds that are made up of large cap companies versus mid cap companies versus small cap companies. Clear? Everybody's understanding? Good. All right. Tip number 4, something that you can do, something that I did until the professor at Rice, bless you, corrected me, is that I did not realize I was concentrating my portfolio with assets. Here's what that looks like. So This, I just took a screenshot of 2 different mutual funds. This one is a T. Rowe Price Blue Chip Growth Fund. One of the things you see, everything looks good. I was looking at the returns. I was like, oh man, 16.92% over 10 years. That's awesome. Sold. You got me, right? Bought it. Look at their assets that they have. Amazon, Microsoft, Facebook, Google, etc. Then you go in and there is the T. Rowe Price Growth Stock Fund, right? Look at their assets. It's the same. So even though I thought I was diversifying by having 2 different mutual funds, I was concentrating my portfolio because those funds were invested in the same assets. Does that make sense? So you need to make sure that, and this is why I tell you to go look at your top 10 holdings, right? To make sure that those funds or those assets are not duplicated somewhere else, because you want to diversify, but that's not diversifying. You're basically you're investing twice. Make sense? All right. Diversifying your portfolio does not mean you need to invest in a lot of mutual funds. I want to make sure you guys remember that. A lot of people think that, oh, I need to diversify. So when you see that, what do you call it? All the different mutual funds that you can select. When you're in a 401k, it's manageable, right? Because they'll give you like 20 different options that you can select from. Exactly.
It's not like
It's crazy, right? When you're out of a mutual fund, if you're in an IRA, it's overwhelming. There's so many mutual funds. There are so many different stocks. Remember, an IRA was one of the most flexible accounts. You can do whatever you want to do with your money. You can buy Apple. You can buy Amazon. You can buy bonds. You can buy commodities. You can buy anything, right? So it can be overwhelming. And many times, a lot of people think, oh, I need to have like 30 different mutual funds for me to truly diversify my portfolio. You don't need to do that. Like, I think thinking about my 401k. I think my 401k has like 4 or 5, maybe 5. Yes, it's already diversified in the mutual fund. If you look at even Berkshire Hathaway, the way that Warren Buffett invests, about 25% of their assets is in Apple. That's a huge number. So 25% is in one stock, not even a mutual fund, one stock. So you just.
Do you mind if I ask this? So who do you watch? Like, okay, that person just did this. Maybe I need to.
It's sometimes. So here's the thing, right? I'll watch. The other cool thing about Yahoo Finance is that you can actually watch, like, you can watch Warren Buffett's portfolio. You can watch like cannabis. You can watch some of the popular cannabis stocks. You can watch some of the IoT stocks. Here's the thing. I have learned not to invest in something just because, yes, is investing in it. And here's why. They understand why they're investing in something, right? If that asset starts to go down and I don't understand, I will freak out. When everything is going good, everything's gravy, right? And I'm like, hey, we're winning. If the assets, and that's what happened to me with Amazon when I was younger, I invested in it because somebody told me to invest in it, and it was great. We were going up, but then when they went down a little. They didn't even go down significantly. I was like, oh, I got to clock in my profits right now, and I sold. So not understanding is going to make you be an irrational investor. That's why if you want to invest in stocks, I highly recommend that you truly understand why you're investing in a stock. Otherwise, stick with mutual funds.
That's good advice.
Yeah. All right. Anyone? All right, next one. If this is all overwhelming, invest in a target date fund. I'm not a fan of them, but they work.
5-6% on target fund.
Huh?
The returns are like 5-6% on target.
It's better than 0. And it depends on where you select. So the target date funds, you'll typically see they have a number at the end. So like 2055. That means it's following an investment profile, assuming that you're going to retire in the year 2055. Yeah. What people do, or what a lot of companies do, is that once you actually join the company, they default and they invest 100% of your money into a target date fund. You have to go in and you have to change it if you want it changed. Okay? All of that makes sense? All right, fantastic. Step 3, develop an implementation strategy. So one of the things that you had talked about last week was the idea of dollar cost averaging. Dollar cost averaging is a technique. Actually, if you are regularly contributing to your retirement account, you are using this technique. Okay, and what dollar cost? This is just an example. Is that you take the same amount and you invest in the same assets. The prices is going to fluctuate, right? So I just did just a simple example. Let's say I'm investing in an asset. I have $1,000 and I have $4,000 I want to invest over the year. I can either take that $4,000 and I can buy all, that asset on January 1st. Or I can take that $4,000 and I can spread it and I can buy the assets over time. Now, the main difference is that if I take $4,000 and I buy, what's 4,000 divided by 25? Anyone got a calculator handy? Augie, come on, you know this off the top of your head. He's like, no. He's like, I ain't got nothing for you. Somebody do $4,000 divided by 20. Huh? 160. So I would have 160 shares instead of 183, right? But that's not guaranteed that it's going to be at this cost at the end of the year, right? So to mitigate my risk, I can just take that and I can spread it out. So on January 1st, I buy I take $1,000. The price of that share is $25. And you do this with stocks as well as with mutual funds. So the price is $25, right? So I buy 40 shares. Then on April the 1st, $1,000, $31 per share. So I get 32.26 shares. You can only buy fraction shares when you're in a mutual fund. Okay? You actually can buy fraction of shares, but that's only in a mutual fund, not with stocks or not with ETFs. It's got to be whole numbers. Just give you guys a disclaimer. All right. Then July 1st, $1,000, but now it's $20. So I buy 50 of them. Then October 1st, $1,000 is now $35, so I get $28.57. So what you do is that the total number of shares I have is 150.83 instead of taking the $4,000 and buying it at any single point in time. This is called dollar cost averaging technique. Okay? Make sense? All right, fantastic. Other investment strategies, there's value investing. You can also even see, I don't want to just think that these are all stocks. I should have said stocks and mutual funds. They have mutual funds that typically follow value stocks. They have mutual funds that focus on dividend investing, so like dividend aristocrats. So these funds focus on investing in stocks that regularly pay dividends. So there are lots of different investment strategies. There's growth investing. I am a growth investor when I am not investing in my retirement portfolio. So I invest in companies that I believe have a growth trajectory. And then there's momentum investing. I don't really recommend you do that because that's just jumping on the bandwagon and you don't know if the bandwagon is going up or the bandwagon is going down. Okay, any questions? All right, step number 4, make sure you rebalance your portfolio. So rebalancing, let me come back to the board. Since we have this up here, right, if my strategy is to stick with 90% equities and 10% bonds, right? And let's say, because right now we know that equities aren't doing as well. Let's say this goes down to 80% of my total portfolio and this is 20%. I can rebalance this, sell some of this, get it back to 10%, buy some of this, get it back to 90%. Rebalancing is just basically a strategy that implements what your strategy is. It basically is selling assets to rebalance your portfolio. Does that make sense?
Some.
Some. Okay, so all right.
So why would it get to 80?
Huh? Because let's say you are invest. Let me know. Okay, let's not look at this one. Let's look at individual, right? So you are invested, and your large cap mutual fund is doing so well. It's grown to a point where it's now not 20% of your portfolio. It's now 25% of your portfolio. Your mid-cap companies, let's say that they're okay. They're still at 20% of your, and this is overall dollars. Your small-cap companies, this one has decreased. It's now 35% of your portfolio. And your international is still 10% of your portfolio. If you want to maintain this strategy where you are large cap is 20, 20, 40, 10, when you rebalance, you will sell some of this. So you get your gains, right? Then you'll buy some more of this. So you're rebalancing to maintain what your initial strategy is. Okay?
And since this is a retirement account, do you still pay taxes?
No, you won't pay any taxes.
Okay.
You won't pay any taxes when you rebalance. All right. I think we're now in the wrap-up phase. Financial tip number 7, this was actually Warren Buffett that said this, raise cash when you don't need it so you have it when you do need it. Okay? Cash is actually part of your investment strategy. Especially when you're in a 401k account, you won't have like excess cash. If you're outside of your 401k account, let's say you want to invest in real estate, you want to invest in market assets, right? Cash is a part of that investment strategy because you need cash when something happens. Remember, a market correction is an opportunity. So let's say your goal is to have 10% in cash at all times. Like in my rollover IRA, I have cash just sitting there so that when the market turns, I can make a move. In my mom's account, she has cash just sitting there too. So when the market turns or when I see an investment that goes and I believe it's at a good value to buy, I can buy it. Does that make sense? All right. All right, final things to remember. All right, wrapping up. Yay, we're going to leave some time for questions. Investing, it's a long game, okay? It's not a short-term journey. It is a long-term journey. And regardless of what you take from this class, right, my goal was not to tell you what to do, but to teach you how to think, right? Your goal is, at the end of the day, is to figure out how do I maximize the potential of every single dollar that comes into my pocket. All right. So part of why we talk a lot about retirement is because they're tax sheltered accounts. That's what the government has set up so that you can get around paying taxes. That's not to say that you won't ever pay taxes. It just means that you'll get around paying taxes. You talk about real estate, right? Where Tim was explaining the last time we met that with real estate, you don't even pay taxes because you can depreciate your house or you can depreciate your assets. So there are lots of different creative ways for you to make money while mitigating your tax consequences. The other thing I'll tell you, you guys will make mistakes along your journey. I told you guys about some of my dumbest mistakes, right? That doesn't mean you stop. So continue, learn from your mistake and keep going. Keep your emotion in check. Greed versus fear. Keep your emotion in check and follow your strategy. You'll succumb to greed or fear if you have no strategy. So make sure you have a strategy. Understand why you want to invest in something. The other thing is you can't time the market. Don't try. What you can do is you can evaluate an asset. Is this a good asset that I can buy that is selling at a good value that I'm willing to hold long term? Okay. And then the last thing is a market correction or a recession is actually a great opportunity for you to get in. So that's why I say store up your cash. Yes?
I don't know how much you may know about this, but how much of insider trading do you think really?
Oh, there's a lot.
I mean, because, okay, I'm thinking now with my daughter, I know that you're invested in XYZ stocks.
Mm-hmm.
And I know because of my position that something is fixing to happen that can significantly affect you.
Mm-hmm.
You know, I mean, do we have like a sign if you see? I mean, you know, but how do I, because it's tough for me to think that even though we never hear much about it, that is not there.
It's only insider trading if you get caught. Look, and here's why I always tell you guys that you know a lot about things. The very first place to start is with your own companies. You know a lot. I was thinking about I know somebody who's an executive, right? He knows a lot about what's going on with that company. He knows a lot about what their goals are, right? They have trading windows as to when they can actually make a trade or sell. And there are a lot of rules there are a lot of rules that you need to make sure you stay within the confines of, so that you don't get slapped with insider trading. But there's you know a lot. You know a lot.
Not more than you know about more than
To think you do, yeah, you know a lot. So that's why I would say. But there is a lot of insider trading to me that will happen. Like, take for example, I had to stop myself, and I was like, oh, I don't want to get burned by the SEC. Before we announced first quarter earnings, they put all of our everybody at pros. They froze. They put you on a freeze, right, so that you can't make any trades, because during sales kickoff they told us what some of our revenue numbers were. Well, I managed my parents' accounts. I could have easily gone to go buy them some assets before whatever, but I don't want that to eventually come back on me, right? So I didn't make any trades, and of course the stock popped, and I was like, yeah, I was expecting it to pop. But you know a lot. Wow. I could sneak and be like, hey, go buy this stock, but yeah. I just left, this is the last just additional resources that you guys might want to check out, read. I added the book. She's actually reading a great book, Elements of Investing. I was stealing it from her while I was on vacation. It's a very, very, very good book that models a lot of the concepts that we've talked about here. So please, knowledge is power, right? The whole goal of this session was to help to educate, but never stop learning. Like I said, I'm not a final authority on investing. There are many things that I also need to know, that I need to learn. I read all the time, reading articles. I send articles to my dad. That's why he doesn't think I work. So I mean, there's a lot of different things that we all need to continue to learn. And as you guys get knowledge, make sure you're sharing that knowledge also with others. Yes.
But as like another tip, a good starting place, once again, I just wanted to make sure you feel like it's a mutual place to start.
Yes, for sure. I wouldn't start off investing in stocks, not with what you know. Definitely mutual funds. All right. I know we didn't leave a lot of questions, but Tim's in the room. I'm here. Jason's here. Ask away. What are some things that we might have talked about? What maybe some feedback you want to give us? Sorry. Yeah.
Can you elaborate a little bit more? Like, what's the target date fund?
Oh, a target date fund is a mutual fund that has a structure with the intention that you have a retirement timeline. So you'll see it say, I wish I knew one of a ticker.
So mine is like an SP 2025.
Yes,
So
and
they're going to sell
They're-
this is how I understand it. They're going to sell it in 2025.
No, they're going to model the retirement risk of that portfolio with the understanding that you're retiring in 2025. So they model the risk based on the retirement date. And that's, remember why I said that part of your risk profile should also be when you need the money. So if you need the money in 2025, then that's what the risk profile they're going to follow. If you need the money, don't need the money till 2055, then they're going to follow a more aggressive risk profile.
You see, again, this is the reason why I think that AI is going to be playing a big role in the future, where here and it looks at your goals, your life, your age, and it just works it all out.
You just like AI. They're already doing that today.
AI is kind of scary.
It is. I mean, it will. Don't get me wrong. It's already doing that. It's already doing that today. So it's also doing that with, if you want to invest in different sectors, you can get a robo-advisor to do that for you instead of you managing it by yourself.
Fidelity has a cheap one called Fidelity Go.
Yep. Any other questions? Yes.
I have a question. I have a lot of questions. This question is based on.
Mm-hmm. Ask away.
It's really based on, the other questions are based on this question.
Mm-hmm.
So you said some terms, you used some terms, and I want some clarity.
Okay.
To these terms, right?
Yep.
You mentioned aggressive and non-aggressive, like you said your dad's aggressive,
Yes.
but is it depending on his age and things like that?
So having an aggressive that's a great question. It basically looks at how much you're invested in high risk assets versus safer assets.
Okay, and there you go again. So you're saying higher risk, there's high risk investing and the high risk strategy, right?
So high risk assets are considered equity assets, stock assets, right? So if you have, let's say you are Chidera, I'm gonna pick on you again. He's not retiring for another 40, 50 years, right? 40 years? Okay, 40 years. He can invest in stocks or funds that have lots of stocks, right? Because it is riskier, but he doesn't need the money now, right? Your risk profile should be when you need the money. I know a lot of people will say your risk profile is based on age. No, to me, your risk profile is when you need the money. All right. So if I have my what do you call it, personal account, right? And I need the money in 3 years, I shouldn't be taking too many risks because I want to make sure that in 3 years I have a good chunk of that money still there. So that's what you would call a more conservative approach. So when you think about those, it tends to be your equities to your bonds mix. So in that example, we use 90% equities, 10% bonds. That's an aggressive profile.
So this is a high risk.
This is a high risk profile. If you were to look at, let's say, a 50-50, that's like a moderate, maybe, profile.
Now let me ask you this. Junk bonds are volatile.
Yes,
right? So
high risk.
if you have a lot of junk bonds.
Yes, it's still high risk.
High risk.
Yes, that's a great question. Because a lot of people automatically think I have bonds. Bonds are safer, so my portfolio is not as high risk. Well, if you have 50% bonds and 45% of those are made of junk bonds, that's still a high risk. It's still a high risk. Profile. Make sense?
But young people usually won't have a low risk profile.
No, you don't need to. I mean, you can if you want. There's some people in this world where it's like, look, I don't want to see my money grow by 20%. I'm good with 4%. I just want to make sure my money is there. If that's you, then you don't need to have a higher risk profile. But what I would recommend is that especially if you're in a retirement vehicle, since you know you don't need the money for long term, you can take a little bit of risk. Higher risk or higher the rewards.
So the reason I'm asking that is because we talked about those active and those passive,
Mm-hmm.
let's say,
Investments.
mutual funds, right?
Mm-hmm.
And the ones that do better are the passive ones, right?
Yes, yeah.
Which is a lower risk.
No. It's not lower risk, it's just not actively managed. Index funds, so the determination of risk is not if it's actively or if it's passively managed when you're looking at mutual funds. The determination of risk is what's actually in the portfolio. Okay? So you can have an index fund that is following the S&P 500, right? The one that we looked at. It's made up of equities. It's made up of stocks, right?
Okay.
It's still a high risk, but it's just passively managed. It means it's cheaper for you to participate. Now, you can also get an index fund that is just made up of it's called the AGG, I think it's the Aggregate Bond Index. It's passive, right? but it's lower risk because they are not investing in high risk assets. They're investing in U.S. Treasury bonds, Japanese bonds, etc. So
You would think that an active investor or someone who's managing like an active and they're following, they're basically trying to get the most for your money. So they're moving around a lot, which makes it a little bit more.
They change the asset. They can change. So there's something I didn't show you guys because I didn't think we needed to look at it. And to be honest, it really does not. It doesn't matter. But there's something called a turnover ratio right here. So you see the turnover rate for an index fund is only 4%. That means that's how often the assets change in the in the mutual fund. If you see an actively managed account, it could be 70%, it could be 30%, it could be whatever. That's just how often they're buying and they're selling the assets that they're investing in. So you would think that if a fund manager knows we're about to get into a recession and he puts himself in a defensive position again is when I have more bonds because bonds are safer. So when I have safe bonds versus exposing myself to equities, right? You would think that by them being able to time that they should be able to do better on the long term. But study shows that it's not because you can't really time the market.
My question for you is, you have the fund manager.
Yes.
Who do the fund managers watch? If they're watching anyone at all? Or do they
I don't
just
know.
watch each other?
They might watch, a lot of them actually watch the index. A lot of them, you'll be surprised at how many fund managers invest in index funds. So, any other question? Yeah?
Do you choose and you find a fund manager that decides to do aggressive, basically like aggressive strategy?
You can tell. Let me tell you how you can tell. Look at the risk category, right? So this one is it's a medium risk. Did I? Oh, sorry. Right here, it says risk category. So it'll tell you how risky. And remember, the higher the risk, right? The higher the reward, right? So typically, when you see higher risk, you'll see like really crazy numbers, right? But you also, when you see lower risk, you'll see smaller numbers. The worst thing you want to see is a combination where it's high risk and low numbers. He needs to be fired.
What she said is a good way to look is always just look at the year to date. You always want to see about like a 5 to 10 year history of the fund.
Yeah.
Give you a good estimate of what the fund is doing.
Yeah, I don't bother with the 1 year. I typically just look at the long. I want to know what you've done long term, and then I want to know who's responsible for the results. If the fund manager that's there is the one that's responsible for the result, then it's a great fund.
Okay. Some of these funds are like they're specific to like sectors, right? Like
Yes.
I think Morningstar is like is in health.
No, Morningstar is just an analyst. They provide different ratings. It's not you can actually go in and
Like that's what she said. There's so many funds.
yeah, look, I can go in and you can do research on mutual funds. It's like over 2,000 that's going to pop up, right? And you can do different research. See, you can see, okay, so I want a rating that's over this. I want high returns. I want low expenses. So 26 funds match this. So I can go in and see the results. All right, which 26 funds? The issue you'll start to see, remember when I say here's a target date fund for you. Look at this, Target Fidelity Freedom Index, 2045. So that's assuming that you have a retirement date of 2045. So look at the risk category, right? Look at the life of the fund, 9.23%. Look at how they are, the asset allocation. So domestic equities, meaning that they invest 61% in domestic stocks. Then they invest 28% in international stock. They invest 7% in bonds. Why? Because you don't need the money till 2045. So why do they need to? Yeah.
I have a question, but on this target date funds, don't the date of inception matter?
Huh? Yes, they have a manager. They have a fund manager.
Do you have the assessment paperwork around?
No, I don't. I didn't bring it this time. Yeah.
So 45 is how many 10 years from now?
Huh?
20 years?
20,
35?
45 is,
25 years?
yeah, 30 something years. So it's, see, 2009, right? So this guy's just been here for 10 years. But I'm not a fan of target date funds just because I feel like you can find better funds. I don't do them, but it's easy. So let's look at some other fund here, right?
Look at the latest.
Which one?
2050 something.
No, I don't want to look at a target date fund. They're going to have a blend. What I'm trying to do, okay, so look at this one, Fidelity Midcap Enhanced. This is an index fund, right? So this automatically tells you that what? The costs are low. It's tracking an index. But the index is made out of mid-cap value companies, right? So you guys hopefully are understanding these terms, right? So look at the turnover ratio. Exactly. It's steady changing. Huh? The turnover is how often they're changing assets or buying and selling. It should be, and actually, that's a good question. I don't know why. That's a great question. But it has a high expense ratio, which means that it's managed. But it's showing geode capital. That's a great question. I don't know. That's a great question. You shouldn't see that. You shouldn't see that. So just for that, I would be like, I did. So you're catching on. So any other questions? Any questions about real estate for Tim? Yeah?
I have a question.
What's up?
Let's say company X decides to merge or buy company Y.
Uh-huh.
And I have stocks in company X. What happens to that stock?
That's a great question. Do they turn it? I know that your stock price goes up, right? But I don't know if you have to liquidate it can you transfer from company X to company Y?
I feel like it's something they do where it's like they calculate how much it would be for you. So basically, they buy it back from you. They'll buy it back.
What is
I
the
don't think
little
the company is.
They buy it back.
Where?
Yeah, they have to buy it back from you. Or set
Which
a
one? These
price
ones?
for it.
Yeah.
Oh,
So
I think
if
it's like
the company
Fidelity
has-
Picks.
The company that you had stock in, right?
Uh-huh.
Yeah, so basically, they will calculate, they have a calculation that they would do that will let you know how much your stock would be worth now with this company as the owner. So basically, you would have the option that they would buy it back from you
I'll keep the stock.
or keep the stock, yeah. But it's actually a word for it. I don't remember it right now.
All right. So showed you guys. You can also. These are also stocks that require no transaction fee. That's why it's pulling these up. So, any other questions? You can sit here. We can sit here all day, right? We could look at, and what it's going to do is, so ratings 4 higher, above, expenses below. So let's look at these 182 results, and you can sit here and you can figure out, oh, look at these. Year to date, 39.4. Whoa. But look at this, even better. Right, I can already tell you what's in here. They are invested in a very tech heavy. This is Amazon, Microsoft, etc. So this was the mistake that I made when I was looking at when I was selecting some of these. I was concentrating my portfolio. See, look at, yeah. So you see here they are expense ratio 7.74. That looks good. So the top 10% of their holdings make up 61% of their portfolio. They're invested in Visa, MasterCard, PayPal, WorldPay, or World, I don't know who that is. Yeah. Yeah, some of them are services. And if you go down here, you can look at the index, right? Oh, look at that. Can you guys see this? Although they're making a lot of money, yeah, so this is their index, MSCI IT Services 2550. So this year, they're a little bit lower. Over 3 years, they've beaten their index. 5 years, they've beaten their index. 10 years, they've beaten their index. Lifetime, they're beating their index, right? So it's like, oh, this looks like a good one. Then once you do, what do you do now? No, not buy it. Thank you. You go to their fund managers. Look at when they're fund managers. So are they the ones responsible for the results? Exactly. Exactly. He said buy it now. So this is some of the things that you guys do as you look at stocks.
So let's say you just look at the fund manager and they came in, 5 years ago. Are you going to look at 5 years?
Yes,
Okay.
I would.
Okay.
I would. If I really like what I'm seeing with that fund performance, I'll look at the 5-year and I have to make a discretion. And what I told, because I actually sat down with Vera and we were looking at some of her profile. I told him, I said, look, you just have to make sure you watch that mutual fund a little bit more closely than to just be like, I'm setting it and forgetting it. So look at how they continue to perform. So look at this one. So for you, risk category, it's higher. You see how it's getting into the red, right? 10-year performance is 16.16%. Expense ratio, 0.72, so it tells me this is an actively managed, right? Look at the top 10 holdings, right? Amazon, Google, Apple, Netflix, Microsoft, Facebook, CRM, right? So these are the companies that everybody knows about. And look at the fund manager since 2009. So he or she is responsible for the performance of the portfolio.
Wait, how do you see that they're the person
Right here.
since 2009? I mean, I see that. So you're saying if they've been there at least 10 years?
Well, no, how long they've been there determines which of these they're responsible for. Okay? And then here, let's look at their index, right? Their index here is the Russell 1000 growth. So for 1 year, they are underperforming their index. They outperform their index for the 3 years. And then you see it kind of normalizes a little bit. So over the lifetime is 11.79, and then what you have to think about is that it's 11.79 overall, but if they're charging me 72%, then doesn't make 72% cost, then doesn't make sense to participate in that. Did that make sense? Okay, good.
They're charging you, sorry, I missed that.
They're charging you 70. Their expense ratio to participate in here is 0.72%. Okay, it's not too bad. That's not too bad. Yeah.
This fund managers pays them, and how do they get paid?
They get paid by Fidelity. They work for Fidelity, so they make a lot of money. Make a whole lot of money. And look, if you want to see how much they have to, so this asset has, this one has $27 billion. So when you talk about fund managers, if you can find us, maybe $27 billion we can play with, maybe we can go set up our own mutual fund. All right, any other questions? Any other questions, guys? You're good? We're going to go off and we're going to conquer the world. We're going to invest our money and we're going to be rich. All right, thank you guys. Thank you guys for being awesome sports. Wow, we finished kind of early. What? Good. Oh, I was going to ask, if you guys are interested in being like, I don't want to say a mailing list because I'm not going to be mailing stuff. But if like periodically you guys want information, or you want to know, maybe we'll have like a follow-up class, whether myself or Tim or Jason has a follow-up class and you guys are interested, please let me know and provide us your email address so that we can, I know, just let me know if I can use them so I'm not spamming you. And everybody in here wants the slides? Yes, no, maybe so? It's holding up. It's not too bad. Mailing list? Just tell me and I'll be